In today's video, we're going to talk about how you can make money stock trading. And be quite honest with you, making money with stock trading is not as complicated as many people want you to believe. In fact, if you are armed with the proper information, you have a good trading strategy, you could be on your way to generating at least a second income. The great thing about stock trading is it's actually available to virtually anybody that has an internet connection. If you have money to fund your account, and even just a few minutes to spare during the day, you do not need to be a professional trader to take advantage of the opportunity that stock trading offers. So in this video, we're going to just talk about some of the basics that you might need to know in order to get started. I'm also going to talk about a few other ways to benefit from the market outside of just buying the shares. So the first thing we're going to talk about is how much money do you need? Really, you don't need a whole lot of money to get started. In fact, with some brokers, you can open an account for $500. And it's pretty easy to find brokers. Just do a quick Google search. And then once you find one that suits your needs, you open up your brokerage account, begin trading. Some of the popular ones are E-Trade, TD Ameritrade, Interactive Brokers, Robinhood. And of course, you are limited in the amount of shares that you can buy, and that's going to depend on your account size. So for instance, let's say a stock is trading for $100 a share, but if you only have $500 in your account, you can, in theory, only buy 4 shares. Now, if I say 4, because you're going to have to pay trading costs. If it's a higher price stock, you may only be able to purchase a single share. And this does not even take into account your risk tolerance. If you buy these shares and price declines, how far are you going to let it drop before you get out of your trade, right? Protecting your capital is job number 1 for a trader. The good thing is a fairly new advance in stock trading is the ability to purchase fractional shares of a stock. And what these shares do, it allows you the ability to purchase a percentage of an individual share. So let's think of Boeing. Pretend you're a small trader and the price for the stock is about $172. If you want to buy 50% of a share, only going to cost you $86. Remember I told you stocks are accessible to virtually everyone, and these fractional shares make that even more possible. Let's talk about margin accounts. And what that is basically leveraging your capital and just allows you to trade with more money than you actually have in your account. You are essentially borrowing money from the brokerage to help fund the purchase of a stock. So let's say you want to buy $5,000 worth of stock ABC. You would use $2,500 of your cash from your account. You would borrow the other $2,500 from the broker. So the stock makes a huge leap in price. The investment grows 20%. And now it's worth $6,000. However, you only use $2,500 of your own cash. So your return is actually 40%. Now, the benefit of trading with margin is it can obviously lead to greater profits because you're holding more shares. However, the risk is also a lot higher because you can lose all your money if that stock price falls even a small amount. Right? This becomes much worse if that small bit of selling actually starts to lead to many positions being unwound. So if that same stock dropped 20%, you actually are going to lose 40%. When you trade on margin, you also have to contend with what they call a pattern day trading rule. And this is a regulation that's been put in place by FINRA and states that traders who make 4 or more day trades in a 5 business day period using a margin account, you're going to be flagged as a pattern day trader. What does that mean? Your account must have at least $25,000 in it. And if it doesn't, your broker is going to limit the amount of trades you can make until you bring that account up to the minimum. Also, with margin, there's something called margin calls. So if your stock that you're in is taking a dip in price, your equity is falling below the minimum margin trading requirement, your broker is going to request more money to be added to your account. And if you fail to fund your account, your broker has the right to sell some of your holdings, and not at the best price. Now, depending on the condition of the market, this sale could result in a huge loss. When we talk about buying stocks, essentially you're investing in a company with the thought that this company is going to do well in the future. That's fundamentals. And the stock price is attractive and others are going to buy in. So if it does well, the stock price goes up because of the demand for the shares. You can make money from your positions when you sell. So a quick example, let's say you buy 100 shares of Apple at $100 per share. So after a year, that stock price goes up to $120 per share. And when you sell your shares, you'll make a profit of $2,000. If the company does poorly, the stock price goes down because sellers are now stepping in, you're going to lose money on your position. You're going to need to sell to protect your trading account. We can also short sell. And this is when you sell a stock you don't even own because you think it's going to drop in price. So what do you do then? Well, if the stock does what you thought it would, You can buy it back at a lower price, pocket the difference. So for an example, let's say you think the stock price of XYZ company is going to fall. You borrow 100 shares of XYZ from your broker. You sell it for $10 a share. The price falls back to $8 per share. You buy it back. Return the shares to your broker, pocket the difference. However, if that price goes up to $12 a share, you have to buy the shares back at a higher price. You're going to lose money on the deal. We're going to talk a different way about profiting from falling stock prices in just a minute. There's also dividends. You can make money from that. This is when companies pay out payments to shareholders out of their profits. So as an example, just using Apple, let's say you own 100 shares. The company pays a dividend of $1 per share. You're going to receive $100. Now, dividends are usually paid quarterly, so you're going to receive 4 payments of $25 each year. Not only that, you also make money on not just the dividends, but also if your share price rises in the future. And right now, from Forbes, some of the most suggested stocks to hold for decent dividend gains are FAF, JPM, PKG. But here's the kicker. Once we're in an era of rising interest rates, that rate of return that you'll get risk-free and guaranteed, right? That may be more attractive to these same investors, and they'll go more to institutional, government type issued investments. Trading stock options. It's another way to trade stocks without buying or selling the actual stock at the offered price. So essentially, the option on a stock gives you the right, but not the obligation to buy or sell a stock at a certain price in the future. If the stock price goes up, you make money by selling the option for more than you paid for it. An example, you buy a call option for ABC company at $10 per share. It's a call, so you expect the price to go up. So this will give you the right to buy 100 shares of ABC stock at $10 per share anytime in the next year, for example. If the stock price goes up to $15 per share, well, you can sell your option for $500 and make that as a profit. Now, there's a lot of different ways you can make money trading options. In fact, our in-house options guy, Mike, he's got a technique that allows traders the opportunity to profit 5 different ways in options. And if you look up here, you can download our options cookbook to give you a bit more information on options trading. Now, there's risks, right? There's risks involved with trading stocks or any instrument. Stock market can be pretty volatile. Prices can go up and down pretty quickly. You can lose money pretty quickly if the stock price falls. Sometimes, in a blink of an eye, you can be wiped out. And it really doesn't matter how good your strategy is. All strategies are going to lose. And a lot of times, you're going to be on a streak of losing trades. So having risk parameters in place when you're trading is so important because it limits the amount of money you're risking in the market at any time. So generally, traders are going to have trade risk and portfolio risk. And trade risk is the risk that's involved with any one trade. Portfolio risk is the overall risk of all the positions that you hold as a percentage of your account. Here's a quick rule of thumb, risk per trade, 2%, 1%. So if you have a $10,000 account at 2%, you should not be risking more than $200 on any one trade. Portfolio risk, most traders keep it at about 10% or a little bit below. So if you have a $10,000 account and you're comfortable with that 10% risk, your entire portfolio should be more than $1,000 at risk in the market. Conclusion to this, look, there's a lot of ways you can make money trading stocks. You can buy and hold for the long term, you trade options, you can day trade. The key really is just to find out what suits for you and just stick with it. But the most important thing to remember, there's risks involved in all forms of trading. So it's so important that you have a plan in place to limit your risk, protect your capital. As I mentioned, you should download the free options cookbook. That way you get an inside track on how we approach options here. There's a whole bunch of strategy videos on our YouTube channel here. Take a look at them. Make sure you like this video. Make sure you subscribe to our channel. We'll talk to you soon.